Good morning. 2026 is just kicking off. We're looking into forecasts around the globe today. And guess what? We're going to have a look at forecasting volatility when trading options. Little interesting here, and I think we have a little debate going. So let's figure it out after the bell. I think if we stop it right after that first little part where we don't get that second part in the future, I think that's just enough Yellowstone for me. And I'm saying Yellowstone, but it's not really Yellowstone for copyright reasons. It's just our little version. Good day, boys. All right, let's get into this because let me tee it up here real quick, and I'll let you guys take over a little. A lot of forecasts, as I said in the opening, right? Folks like to forecast stock direction, investments, yada, yada, all kinds of things. The rain, corn crops. Options traders look at how to forecast volatility, right? And there's two types of volatility. At least there's probably more types of volatility, but the ones that were important to us in the trading world were realized, which is how the underlying moves or moved, and then implied volatility, right? Which is, what the option prices are implying the move will be. Okay, so one's a little bit more forward-looking, one's a little bit more backwards-looking. However, all the math geniuses in the world came up with a few metrics that kind of fold into here, right? So we're going to kind of talk about those a little bit. Who wants to start? First of all, should we just say what the two main forecasting features are? Sabre, Garch. I know there's many more, but how do you want to do that, Mark?
Yeah, Mark, you could take it.
Yeah, I think the premise here is that, by the way, this might be like the last week that you can actually make forecasts for 2026. I think after this part, like we're already 2 weeks in. Come on, get
I know
predictions.
It's like you can't say Happy New Year anymore. The Larry David episode. You just can't
exactly
do it.
what I'm thinking of.
Let's predict what 2025 will end at.
Mm-hmm. That's how it feels like to me most of the time. Anyway, all right. Sorry, Mark. Go ahead.
So obviously, every options trade is a prediction about volatility, right? Like if you're buying an option, you're making, you have to have some opinion on the volatility. And even if that just means it's cheap enough to fit into your directional risk reward idea. So how do you have that opinion about volatility? And I think it's worth talking about the couple different ways you can think about, what that implied volatility should be worth. Obviously, comparing it to the market. And then also kind of more complicated, like you were saying, like models like Sabre start talking about the relationships between volatility. So how different, options within the same term and how term structure across time, should, be related.
Right.
So a lot to dig into here.
Yeah. So do you think that, and Jason, I'll let you respond in a second. Do you think that and now again, look at, we talk to a retail audience, okay? And I'm on the warpath now of keeping things very simple for retail people, okay, to the point of almost erasing all this if possible. But there's some caveats, which we'll talk about today. But do you think that the typical retail user of options has to have such a deep dive into Garch and Sabre? Is that important? Or is it more, it's important if they trade a specific way relative to having inventory that is centered on implied volatility, as opposed to price movement and that sort of thing? Any thoughts there? Or did I not say that right?
Overall, I think the average retail trader, if they're trading options, would look at the option price. And if they have a thesis, they should probably use just current option pricing. Stuff like Garch and Sabre are meant for pricing the option that has no, like if it's a new issuance and something, what are you going to do?
Yep.
You just look at history and you figure it out. You figure out a pricing because you have to make a market. I think if you're a normal retail, like, schlub like us, we have to look at stuff like what is the current straddle price, and then see if we think it'll be more or less volatile than that. Or, how are we going to measure skew? So 50 delta, 25 delta, kind of do a measurement like that. And I think that, so overall, you need a thesis before you go into anything like this.
Mm-hmm. Okay. Does anyone have a good definition of both of these terms we're using? We're throwing around Garch and Saber. I'll throw out the common layman's version. So Garch is sort of what, given what just happened, how volatile will tomorrow be, sort of, and tomorrow can be, a term, right? So it kind of looks at realized past results and predicts future ones.
Yes.
Okay. And then Saber, I think, Mark, you mentioned it when you were talking about it. It gives, given, today's prices, let's say, what does the market believe about volatility in a strike-to-strike relationship and a term structure relationship? Is that loosely accurate, would you say?
Yeah, I think while Garch is a really long and complicated name, it's basically a better quote unquote way of thinking about historical volatility. So like the simple way of calculating historical volatility, and like, let's just say that is the baseline, like kind of the best way to predict what the future is going to be is most likely the recent past. So if you want a good indicator just out of nowhere of what the 30-day implied vol should be, look at what the 30-day realized vol was. And I think that's, as good as any indicator if you're going to start talking about,
Sure.
what should happen. And
Right.
Garch kind of builds on that and thinks about, rather than just a simple average, how we can, apply more context to that, historical and predictive based on historical volatility.
Okay. Now, do you use either of you guys? Do you use Garch in modeling at all for your more of your investment strategies, let's say, or no?
I mean, I could go first. Garch, I mean, it's basically a distribution, right? We could just kind of like, it's super layman term, right? And we look at the distributions of what markets are currently pricing. We kind of alter that based on positioning. And that's the biggest issue I have with both Saber and Garch is looking back to see the future. I mean, in every single disclaimer, now I will have to admit, I have not read Molly's TV disclaimer, but I'm pretty sure somewhere in there is like a thing that says past performance does not guarantee future results. And what we use to kind of, I don't want to say, what we use to develop our thesis against the current market volatility is the dealer positioning and what they would need to do to hedge as price is approached, as that strike is approached.
Yeah. Okay. So I think someone would ask, okay, great, I got this data in my toolkit. Are you telling me that volatility is mean reverting? If we look back in time and we're getting a stat on this and we're saying that high implied volatility today that looks like in the past should be some number lower, it's a mean reverting function, and therefore I should take advantage of that. High vol, I sell it. Low vol, I buy it. Very layman's terms and very simplified. But yeah, is it something like that as well?
Yeah, like IV percentiles would be like a common way of quantifying that, right? Like people like to say that, okay, it's in the 90th percentile. It's more likely to go down to the 50th than it is, to up or whatever. So like, I think that's good. Yes, volatility is mean reverting, like just, technically.
Yep.
And I think high volatility isn't necessarily a reason to guarantee sell it. It is going to mean revert, so much as good context about where that mean is, and
right.
A point of light about, if you're going to get short this, like, are you in the 90th percentile or the 10th percentile? That's just good information to have, whether you're writing covered calls or, doing a lot of different strategies.
Yeah, good. Okay. Let me make a comment and ask you, and let's move to Saber, because I think you understand that pretty well. And Jason, I don't know if you do or not, but you probably do, but I don't. I will say that. I know what it is, but I don't, know the mathematics behind it. I have to look at it. But after we do that, I want to tell a little tale about strike-to-strike relationship that happened to me in a bad way. In real life, this happened, and I think hopefully for the folks, it emphasizes how important it is to have a theoretical binder that you can use to price your options well. Okay, and I'll explain all that when we get to it. Okay, but first let's go back and talk about Sabre. Mark, I don't know that one as well. You said you're a little bit more versed in Sabre than the average bear. Well, tell us a little bit about that one.
Yeah, as market makers, we use Sabre quite a bit as kind of a benchmark, like especially in illiquid issues. Like that was helpful. It's helpful to create, and all vol models are helpful to define, like you say, the relationship between different points. And so what the Sabre model kind of generally does is it has a couple different knobs that you can adjust, the at the money vol, the wings, the slope, and you essentially use those to fit to the market. And you say, okay, these options might be priced here, but given, some theoretical model, what should the relationship be between these? And so, real markets are going to move in different ways, whether it's because of wide markets, because of big order that just came in, any of those could, put kinks, so to speak, in that curve. But whether it's Sabre, whether it's SVI, these are all saying that given volatility assumptions and vol assumptions and, spot vol correlation assumptions, what, should these different options be priced as?
Right. Okay. So that's great. So it deals with the skew of a term structure, safe to say, among a few other things, right?
Yep. And like Sabre parameters are comparable across months, for example, so that there should be a relationship between, the like wings in different months. In near-term months, you're going to see much bigger wings. In back months, you're going to see much flatter wings. So, there isn't like a formulaic relationship, but they're, generally given the assumptions of the model, like, the relationships that you should expect to see between different options.
Right. Okay. Got it. Jason, any comments on that model at all? Do you guys use that at all?
We don't use it. I mean, again, because we try to avoid. We're trying to price not based on realized volatility. But the other thing too about Sabre, it's a stochastic model, right? So it's kind of a flow one, right? Or it's like between 1 and -1 or something like that, right?
Well, that's what the S stands for. Absolutely.
Yeah.
But then, we alpha, beta, and rho are the at the money vol, pump, and tilt of the curve. So
right.
Yes. Yes. Right. What's your pump figure? Is that the smirk at the
that's
call?
what we call the wings. That's like that might have been local slang, but like
still was what we used too. So we made that. We thought we made that up, but it was the slope of the.
Maybe we stole it from you.
You might have. I don't know. We always called it tilt. We had that built into our formula too. So anyway.
Yeah.
Okay. So you're not exactly Sabre-esque, Jason. Mark, you're a little bit more than that. Let me tell my.
I think it has, and like to be clear, like I'm talking about from a market making perspective.
Yeah.
Issues that you need to like have that kind of relationship, determined. Like I wouldn't fit a Sabre curve to the SPX right now and just whack everything that's out of line.
Right.
Sabre really, I think, I'm getting a little over my skis here, but like Sabre has fewer parameters than some of the more advanced like SVI and 6 and 7 factor spline models that are out there that you need to price index options.
Yep, 100%. Okay. So let me tell my story, okay, about this, and I think I'm gonna go to the screen here for this one, okay, because this will be pertinent to the. Let's go to the screen. I'm sharing here, so let's go to the screen real quick. I'm going back to the remarkable, for God's sakes, my trick and scratch. All right, so this is a real world example, and this is XYZ stock because I typically can't use real stocks, but let's pretend. But this really happened to me, okay? So this is a typical skew curve, okay? And let me just explain what I have here. Y-axis, implied vol, okay? X-axis, strike. And, typically we see these where you have the at the money right here in the center, right? That's the fulcrum point in a skew, let's call it. So around that fulcrum, the skew can steepen or flatten, right? And we called tilt or slope that, kind of the difference between the 25 delta call and put. We inverted it. It's a negative number. We made it a positive number for whatever reason, but, it is what it is. So that's that relationship. And then what Mark was saying about hump or whatever we call it. I forget what we call it. We might have called it smirk, but it's where this piece beyond 25 starts like smiling or smirking up and, tilting up. Okay. So what typically happens is you may be able to fit these curves to the implied out there. Okay. Which is fine. What we ended up doing is figuring out what was a mean sort of tilt. Okay. Or, that what was average in a stock across term structure as well. And then we would, see when it got steep and see when it flattened. Okay. When the downside puts were cheap relative to upside and at the money and vice versa. Now, that's number one. And these are related, and we normalize these across time. No, number two is that you may have, here's bids and offers around this curve, right? Down on the bottom. But every once in a while, okay, you may see something like this where the bid is like that. Now, you don't see that much anymore. But what happened to me is that I got into a situation where I was rolling down a put spread from, let's say, here to here. So I had to buy in the short put spread closer to the at the money and sell out a farther one. Same term structure. Okay. Now, being the nut job that I am, and we can, well, let's just stay here for a second. Being the nut job that I am, I wasn't paying attention. I was on the phone, probably talking to someone else on the phone at the same time. Spread came up on my trade hawk. Midpoint is, about the best I'm going to hope for. I looked at the midpoint. I didn't pay attention to much else. I shaved a few cents off the midpoint or even a nickel or dime. I got filled immediately. Okay. Now, you're thinking, why would you get filled at midpoint immediately? Well, I didn't pay attention that the markets were really, really wide in this particular issue. Okay. And I'm sure that one option was really skewed or two options were skewed in a four-legged spread, and it caused the midpoint to be a little bit askew relative to true theoretical value of this curve that Mark just described, that relationship. Mm-hmm. So I put the order in. I got filled better than midpoint, and it was still horrible. I locked in a loss automatically, an automatic loss on the position. Okay, can't do anything about it. Okay, and my point here is we can go back to we can not stop sharing now. My point here is that with a theoretical, this is where I'm a big pro theoretical model guy. With the theoretical model built into our trade ticket that says this option, I'm making these numbers up. This option is worth $3. Okay. You just paid $3.82, you idiot. Okay. Now I know I'm not going to get $3. I might get $3.05, $3.10. I'm okay with the negative edge. I just don't want to give dollars away and lock in losses. So if I had that visual that's built in, and again, I don't care how the stoplight works. I just have to know what it means when I see it. Red is bad, green is good. And, I'm making those colors up too, so that I can prevent myself from making a mistake. That's what I think a retail person could use. You don't have to know how the sausage is made necessarily. You have to know what it means when you see it, period. Mm-hmm. Does that make any sense at all? Or do you guys have any questions about how stupid I was?
No, absolutely. And it's honestly, it's a huge issue too with a lot of people assuming that the mid price is the theoretical value, and it's not. It's, it's not. And you have to, if you're going to trade options seriously and profit off of it, you need a theoretical value that is a lot more reliable.
Yeah. Yeah. That's a good point. Yeah, go ahead. Mark, you were going to say something? Sorry.
No, my main comment on that would be that it's a liquidity question, right? That I can be very confident that in SPX, the midpoint is going to be very close to the theoretical.
I was going to say that too as well. Yep. Good point.
I'm much less confident in, Riley or Tier F, name.
Yeah. So I did, and look at, I'm just I'm an addict, and I'm back in the game again, junking around. And this one was one of my trade idea generators. It came up as a big long for me on my system. I'm like, okay, I'll get in. What the hell? I had to do a little maneuvering, and I didn't pay attention to the liquidity. Bad Lex, no bueno. But you're right. I think spiders, penny-wide markets everywhere, massive size. Okay, you're not going to get me there for the most part. It's when the stock, when we get to, what do you think, Mark? Tier T, tier D or C and beyond. C, D, E. Kind of, you should pay attention probably to something.
It's a spectrum, of course, but it falls off pretty quickly. Like I find that there's a major difference between issue number 1 and issue number 200. Just in terms of like average daily volume and how wide the markets end up being and all that. You get down to even like an Airbnb, for example, that's flirting right around issue number 200 in volume right now. I see it float on and off my list. That's why I know. And so those are wider markets, like spreads get significantly more expensive there. And there are 1,800 issues below that, more 2,800 issues below that.
Yeah, no, this is a good wake up call for me. So what I did is, just so everyone knows who's halfway paying attention, I immediately went to the developers and said, re-implement our SKU functionality into Tradier Pro. So that's coming. We're working on that now. I was just in Charlotte with the team, and we're going to be putting that into Tradier Pro. It's going to be what Mark described in terms of inputs. However, there's going to be very little work to be done as a user. It's going to be, yes, I want to use the Saber, and we're not going to call it that, but the SKU function, theoretical SKU, or no, I don't. And you'll be able to steepen it and flatten it. And you're also going to be able to see where the curve is cheap and expensive by color coding. Okay. So when downside puts become more expensive, it's going to show that they're red relative to your model. Now you make a decision as a trader. Do you want to steepen the curve, or do you want to do something with that? Do you want to trade it? Up to you. Right. But you will see visually shocks to this. And it's really, we've done this before. It's really cool to see it because you can look back and not even look at numbers and see what the curve's done, right? And if you see greens and reds on the same part of the curve, you know something's screwed up. You got wide markets in there, and be careful, right? Does that make sense to you guys, what I just said?
Yeah. But you're basing it on like Saber and Garch and then the current pricing?
Yeah, and then the relationship, and Saber part of it is the relationship of strike to strike, what that curve should look like. And not just take, and just so people know who might be a little bit more intermediate here, and they're saying, wait, I don't get this. If you take an implied look at the curve and you hit, set to implied, and you have a sawtooth in there where an option's out of line or something's really wide and the midpoint's going to be way higher, that's not theoretical. That's anti-theoretical. So we want to take that one that's out of line and smooth it back into line so you can see where your problems are. See what I mean? Yeah. Now you're not going to get that, as Mark said, in the very liquid places. You're going to only get it in, I said TRTs, but who knows? Just a slightly less liquid places. You may see that once in a while, right? So it's just a good check and balance. That's all I'm saying. Good check and balance so you don't make a dumb mistake like I did. It cost me a lot of money, by the way. It was dumb. So anyhow, I just took up a lot of time. I apologize. So what do you guys think? Anything else you want to add, we should add here before we sign her off? Don't all jump at once.
Go ahead, Mark. Keep it simple, stupid. I like historical vol. If you're going to look at anything, look at that.
Okay. And then, Jason, I know we didn't get to some of your topics about Volin, but we're going to do that on a separate show exclusively. So you can tee it up what you're going to want to talk about, but then we'll say we're going to do it later.
Okay.
So what is it we're going to talk about? Just something clear.
Oh, well, we're going to talk about how to reprice based on the current positioning of the instead of historical vol.
Okay, cool. I like it. Awesome. All right. What else, guys? That's
it.
It's just been like crazy busy for me. I don't know. I one of these days I'm gonna do something a little different, and we're gonna do a little. Let's watch Lex's crazy trades. And Mark, I've talked to you about this. My new theory on options trading for retail people. I'm simplifying this to no end, and I'm gonna do a little process with you guys on the side and see if it works relative to a show of how fast I can move that machine. And just looking at colors, I know what to do that quickly.
Okay.
So it's pretty cool. Once I have my thesis, now granted, you have to have the thesis first.
Mm-hmm.
And once you have it, if whatever it is, you could be wrong. Don't get me wrong. But once I have that thesis, I can sit back here, look at the screen, and know exactly what has to happen based on the colors on the screen.
All right.
Live trading with Lex is going to be
live trading with Lex, and it is mind-numbing how fast I can be on this machine. You will freak out.
Mind numbing can mean so many things.
It can. It can mean that I have, a really weird outfit on. It's really mind numbing. So you just never know. All right. Good deal, everybody. Welcome to 2026. Get busy. Check out these guys. Mark is at harvestedfinancial.com, I believe. Rita's till jasonval.land. Make sure you sign up for him and check all that stuff out too. Don't forget to sign up for hub.tradier.com. There's all kinds of promos going on over at Tradier right now, and we are revamping the hub page coming soon. Meetings today on that. It's going to be quite an interactive community, so make sure you sign up. It's free. And the last little plant, early stages of the live summit in, we hope, Southern Florida in the early spring. All systems seem to be firing right here on that. So we would love to see you folks who like to watch us come and see us live among some of the other hub hosts and other people who are wonderful in the space. It'll be a great few days. And, we hope we can make it. Comments, questions, anything, guys? Are we good?
Happy trading.
As always, happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.